If you want to invest $200,000 or close to it with the goal of making $1 million, this video will help you figure out what your choices are and how to best put your money to work. If you're not sure what to do, talking to a business advisor can help you come up with the best plan. You can't be sure that your $200,000 will turn into $1 million, and you can't be sure of when it will happen either. Though, there are some smart money moves you can make that will help your investments reach your long-term goal more quickly. Let's talk about how to set up a successful investment plan before we look at the different types of investments. You can do these things. Look at where you started. It's not easy to get $200,000 to spend, but if you already have that much saved, your total financial situation might change what you can invest. Debt from things like credit cards or school loans can make you feel bad over time. That being said, getting out of debt might be a better idea before you start making major investments. You should also think about whether your monthly bills and income will force you to use your savings in the future. If you don't have a steady source of income, putting hundreds of thousands of dollars into long-term investments could make it hard for you to pay your bills. You should also think about how long you plan to spend. If you're not retiring for a long time, your money has more time to grow. On the other hand, it will be harder to reach your $1 million goal if you only have a short time to spend. Figure out how much risk you are willing to take. What investments you feel comfortable with will depend on how much danger you are willing to take. The returns on different investments are then different. Avoid taking risks and stick to shares and CDs if you want to reach $1 million. Your path will probably be so slow that you won't make it. There is more reward for taking on more danger. If you participate in the stock market, you might lose money, especially in the short term. But market downturns usually end in the end. Accepting more risk goes hand in hand with figuring out where you are now. Most of the time, your savings will grow faster if you spend more time in the stock market. When you invest, you can never get rid of all danger, while still having the chance of higher returns. Figure out how much risk you are willing to take and then put your money into different funds that will give you the returns you need to reach your goal. Still, you don't have to put all of your money into small-cap index funds to get good results. You don't try to beat the market by investing in special funds when you put your money into an S&P 500 index fund. Instead, it looks at how the best companies in the market are doing. This fund has given an average annual rate of return of 10% for over 90 years, though it is still open to some risk. Start right now if you want to be matched with local financial experts who can help you reach your goals. Figure out the returns you need. Making a list of your goals will help you see how you can reach your goal of $1 million. Your path to $1 million will depend on three main things: how long you have to invest, how much you can invest each month, and the rate of return on your investments. Let's say you're 40 years old and want to retire at 65. It looks like you joined the investment world a little late, but you have $200,000 to spend and can add another $125 every month. Smart Assets Financial Calculator shows that after 25 years, your investment would be worth $979,618, and you would be 65 years old. You would be almost at your goal, and you could make up the gap by putting away an extra $25 a month. For this to work, your investments need to earn at least 6% per year. It's not impossible to reach this rate, but it would still take some planning and thought. Your goal could be reached with a diverse set of investments. Choose where to put your money wisely. It's possible that there is more than one way for you to reach your wealth objectives. If you know how much risk you are willing to take and how long you want to spend, the next step in building your nest egg is to decide how hands-on you want to be with your investments. For instance, many index funds have given good returns in the past and don't need your regular supervision. Or maybe you want to trade more actively and get better returns. In this case, you might invest in stocks, mutual funds, and exchange-traded funds, ETFs. It's important to do your homework. Put your money into funds that will give you the results you want, and spread out your assets. Of course, no single investment is a sure thing to make money. However, the most stable gains are most likely to come from a portfolio with investments in a wide range of sectors and businesses. As your time frame comes to an end, you will change how you vary. You can profit from market changes and make up for losses over time if you start out by being bold. Then, when you are almost ready to retire, moving to mostly low-risk, low-yield bonds can help you keep your gains and still give you a small amount of interest. Keep taxes and fees as low as possible. There are costs that come with every type of business. Some costs will cut into your returns, whether you're trading stocks yourself or hiring a financial advisor to handle your account. But don't let these prices bring you down. You get strong results on your investments if you do them right. You have to pay to buy and sell on the stock market, even if you handle your own finances. Taxed money is the other half of the cost of spending. That's because you want to keep as much of your cash gains safe as possible. Different things are taxed in different ways. For instance, an increase in a tax-advantaged account like a 401k or individual retirement account, IRA, is not taxed right away. When the money is taken out in retirement, it will be taxed. On the other hand, a Roth IRA is charged when the money is put in it, but not when it is taken out during retirement. If you have taxable accounts, you also have to pay short-term or long-term capital gains tax on stock gains. You only have to pay the long-term capital gains tax rate if you hold on to a property for more than 1 year. This rate is usually the more forgiving of the two. Tax loss harvesting is one way to spend that doesn't cost you any money in taxes. You can lower your taxes on some of your purchases by selling stocks at a loss to cancel out any gains you report. If you sell investments that are very close to the ones you sold within 60 days, you might lose any tax benefits. Again, there are many good ways to put $200,000 that will make you money. You'll have more time for your money to work for you if you look into chances that interest you and start right away. The following assets can help you start building a strategy that can handle market volatility. Buying stocks. Most likely, you are putting in stocks right now if you have an IRA or 401k. Usually, these accounts don't need as much work. On the other hand, you could buy and sell stocks that you personally choose based on your own knowledge and experience. With stocks, you can profit from the growth of some of the world's most well-known companies. Stocks can be risky than other investments, but putting some of your money into them will make your portfolio stronger as a whole. Homes for sale. Real estate has long been thought of as a safe business, and there are many ways to do it. You can make steady money by doing things like buying homes and letting them out. Real estate investment trusts, REITs, also let you invest in a wide range of real estate buildings without having to manage each one individually. You can buy and sell REITs on the stock market, which makes them like a financial fund. So you don't have to take care of the buildings yourself or hire someone to do it for you. You pay fees to the company that runs the trust instead. Share your views with us in the comment section below. Subscribe to our channel for more amazing videos like this.